Welcome to the Deep Dive. Our mission here is simple. We cut through the noise of corporate earnings, pull out the really important nuggets, and hopefully arm you with some surprising facts and insights. Today, we're plunging into the second quarter 2025 results for Marsh McLennan, a true titan in, risk, strategy, and people.
Exactly. Yeah, we've come through the entire earnings call transcript, and what it reveals is it's a fascinating duality, really. You've got strong financial performance on one side, and then on the other, a remarkably candid discussion about some pretty thorny macro challenges and specific industry shifts. It's truly a look at how a global leader navigates an incredibly turbulent world.
All right, let's start with the big picture then, the headline numbers. What were the standout figures for Marsh McLennan's second quarter?
Well, they certainly delivered a solid quarter, mostly right on track with their expectations, even with that shifting economic backdrop. Consolidated revenue hit an impressive $7 billion. That's 12% growth overall. But for folks watching the core business underlying revenue, that was up a robust 4%.
Okay, 4% underlying. And how did that translate to the bottom line?
Yeah, good question. Profitability really shone. Adjusted operating income jumped 14% year over year. And what's really crucial for understanding their efficiency, their adjusted operating margin expanded by 50 basis points. That's half a percentage point, bringing it to 29.5%.
Half a point margin expansion, that's pretty significant.
It is. And adjusted earnings per share, also healthy growth, up 11% to $2.72 per share. And a clear sign of confidence. They announced a 10% increase to their quarterly dividend. That marks their 16th consecutive year of dividend increases.
16 years. Wow. That definitely speaks to consistency.
It really does. It's a testament to their financial discipline over the long haul.
Those are strong headlines. But You mentioned that fascinating duality. Where does it get really interesting when we start to peel back the layers? What are the key drivers and maybe some of the underlying challenges?
Right. The real story, I think, unfolds when you dive into the segment performance and those major macro themes that really dominated the conversation on the call.
Okay, let's start with their core then. Risk and insurance services, or REIs. How did that segment perform?
So REIs, which is their largest segment, right? Revenue there was $4.6 billion. That's 4% growth on an underlying basis. Their adjusted operating margin in REIs also expanded by 30 basis points to 35.6%. So strong profitability there too.
And within REIs, Marsh and Carpenter.
Yeah, exactly. Within REIs, Marsh, their insurance brokerage arm, that grew 5% underlying. And the key insight here, I think, is how they're strategically capturing growth in specific international markets. They seem to be outpacing their overall performance there, showing some targeted geographical strength.
Like where specifically?
Well, they call that EMEA, up 8%, Asia Pacific up 4%, and Latin America up 3%.
Yeah.
So good international momentum. Then Carpenter, their reinsurance brokerage, also grew 5% underlying, which is pretty solid performance, especially considering the softer reinsurance market conditions lately.
So how did they manage that 5% in a softer market?
It was boosted, they said, by record new business and also significant insurance-linked securities, or ILS activity. For anyone maybe not familiar, ILS are things like catastrophe bonds. They let insurers transfer massive risks, like from hurricanes or earthquakes, to the capital markets, frees up insurer capital. And Carpenter participated in 14 cat bond issuances just in Q2 alone. That's a crucial way they help clients manage those huge potential payouts.
Okay, so strong on the insurance side, managing risk, transferring it effectively with things like cat bonds. What about the consulting segment, Mercer and Oliver Wyman? Was it a similar story there?
Not quite. The consulting segment as a whole grew 3% underlying, so a little slower. Mercer's health business saw pretty good growth, 7%, that's robust. But the wealth business, that grew only 2%. And this is despite a huge 36% year-over-year increase in assets under management, or AUM. They hit $670 billion in AUM.
Hold on, a 36% AUM jump, but only 2% growth in wealth revenue. What's the story behind those numbers? That seems like a disconnect.
That's the critical nugget right there, yeah. While the AUM jumped, a lot of that was thanks to acquisitions. The deeper insight is the slowdown in organic wealth consulting, especially in the US and UK. It tells us that even strong segments are feeling the pinch of economic uncertainty when it comes to, project-based demand. Things like pension consulting projects seem to be slowing down.
Okay, so discretionary projects getting hit.
Exactly.
Yeah.
And Mercer's career business actually contracted 5%. Again, tied to softness in U.S. project demand, likely linked to that economic uncertainty, and also lower voluntary employee turnover. Fewer people changing jobs, less demand for certain HR consulting projects. Oliver Wyman, though, the other part of consulting, they grew 3% underlying, led by strong performance in the U.S., kind of navigating that slower market environment pretty well.
Interesting divergence even within consulting. Any other financial headwinds mentioned?
Yeah, they did note a headwind from fiduciary interest income. That was $99 million, but down $26 million compared to last year because of lower interest rates. Though they do anticipate a slight uptick to maybe $105 million in Q3. On the other side, interest expense also rose quite a bit to $243 million. That was mainly due to debt they took on for the McGriff acquisition.
Okay, so a lot of intricate moving parts there, varying performance across the board. You highlighted how they're navigating macro challenges earlier. What's the broader economic climate they described? How is it hitting their clients?
Well, this raises that important question, right? How are businesses coping with this highly uncertain global outlook? Marsh McLennan themselves highlighted that the macro environment is characterized by, and this is quite a list, ground wars, culture wars, trade wars, extreme weather, and the rapid development of AI.
Wow, that's a lot.
It is. And they cited an Oliver Wyman and NYSE survey of 165 CEOs. An astonishing 89% rated geopolitics, trade, and industrial policies as a risk to their company. That's a 20 percentage point jump from just last year.
20 points in 1 year. That's huge. So what are CEOs doing about it?
Well, the survey suggests CEOs are clearly prioritizing trying to extract growth in a slowing economy while also tightly managing costs, focusing on near-term issues. And this is precisely where Marsh McLennan sees their opportunity, right? Advising clients on resilience, on supply chain risks, and importantly, on the profound impact AI is having on workforces.
It definitely sounds like a turbulent landscape for their clients. And you also mentioned the U.S. litigation landscape as a specific significant issue. You quoted them calling it a tax on our economy. That sounds pretty painful.
It absolutely is. They were very direct about it, calling out excessive litigation and abuse of the legal system in the U.S. A pretty damning indictment, like you said. They pointed out U.S. liability insurance rates are already the highest in the world. And these escalating costs, they argue, risk stifling investment and growth.
Did they give any specifics on that, like how bad it's gotten?
Yeah, they noted a staggering 400% increase in what they call nuclear verdicts. Those are cases exceeding $100 million just over the past decade. That data came from the U.S. Chamber of Commerce. And this trend, they said, led to the most severe adverse reserve development in U.S. liability insurance since the 2008 financial crisis back in 2024.
Okay, adverse reserve development, that sounds important, but maybe a bit jargony. Can you unpack what that actually means for an insurer and why it's so significant here?
Sure. Yeah, absolutely. Think of insurance reserves as money insurers set aside today to pay future claims they expect from policies they've already written. Adverse reserve development means they've realized they need to put more money aside than they initially estimated for claims from past years. Usually because those claims are turning out to be way more frequent or way more expensive than they thought. It's a huge hit to profitability. It's like a retroactive increase in their costs. And it shows that the U.S. tort system, in their view, is causing unexpected liabilities to suddenly emerge from prior years.
Got it. So past estimates were wrong, and now they have to pay more.
Exactly. And this environment has pushed U.S. excess casualty insurance rates up cumulatively by 150% over the last decade, including, get this, a significant 18% increase just in Q2 alone for U.S. excess casualty.
18% in 1 quarter. Wow.
Yeah, and they even pointed out what they saw as a missed opportunity in recent legislation. They felt it could have changed tax policy around litigation financing. They argued that injured parties pay ordinary income tax on settlements, while litigation funders, especially foreign investors, often pay much less tax or sometimes none at all. It really underscores how systemic they feel this issue is.
So with this escalating U.S. litigation creating such a headache, how is that impacting the broader insurance market globally? Are rates still just surging everywhere, or is it more nuanced?
This is where it gets really fascinating. It's definitely divergence. Overall, commercial insurance rates globally actually decreased 4% in Q2. That follows a 3% decline in Q1.
Decreased, even with all the talk about risk.
Yeah, decreased overall. Primarily driven by property insurance rates softening. And this is despite a surge in catastrophe losses recently. This softness was seen pretty broadly. Latin America, Europe, the UK, Asia, and especially the Pacific, where property rates were actually down double digits.
Okay, so property is softening globally. But what about casualty, given the U.S. situation?
That's the other side of the coin. Global casualty rates increased 4%. And no surprise, U.S. excess casualty was up that significant 18%, directly reflecting the challenging U.S. liability environment we just talked about. Meanwhile, workers' compensation rates actually decreased by 4%. So really different stories depending on the line of business and geography.
And reinsurance. You mentioned softer conditions earlier.
Yeah, in reinsurance, mid-year renewal rates decreased by about 5% to 15% for programs that weren't heavily impacted by recent losses. Seems like increased capacity from reinsurers, plus that record catastrophe bond issuance we mentioned, kind of outweighed moderate demand from clients.
Okay, so a really complex pricing environment out there. With all these macro uncertainties and specific challenges like litigation weighing on clients, how is Marsh McLennan leveraging new frontiers? Specifically AI. You said they seem really excited about it.
Oh, they are incredibly excited. You can hear it in the call. And it's clearly a critical part of their strategy.
Yeah.
They see it as a way to create efficiency, move faster, generate better insights for clients and for themselves. What really caught my eye, though, is how thoughtfully AI seems to be getting integrated across their diverse businesses. It's not just one thing.
Can you give some examples?
Sure. Mercer, for instance, is introducing agentic AI interfaces, they call one ADA, into their talent portals. The idea is to enhance how clients interact with their HR data. Oliver Wyman, where they said 25–30% of their work already relies on advanced analytics, they're leveraging Gen AI now to help clients with their own AI strategies and even build new AI-powered businesses. Marsh, on the insurance brokerage side, is using AI in their Centris portal for supply chain analysis. And they have an agentic tool working over their absolutely vast claims database.
How vast are we talking?
They mentioned analyzing $1.12 trillion in premium and holding $100 billion in claims data. So using AI on that to track trends and negotiate better terms for clients. And Guy Carpenter, the reinsurance broker, is applying AI to help clients manage catastrophe risk and, interestingly, model future climate change impacts.
So it's really being embedded everywhere.
Pretty much. And they truly believe their unique data sets, combined with their capacity to invest and just their sheer scale, provide a significant competitive moat, as they put it.
A data moat fueled by AI. That's a powerful statement about their competitive advantage. So, okay, let's try and connect all these dots. We've got the solid financials, the macro headwinds, the litigation issues, the insurance market divergence, and these strategic AI investments. What does this all mean for you, the investor, looking at the bigger picture here?
Well, I think if we connect this to the bigger picture, it really highlights how these big external factors, everything from geopolitics to the weird nuances of legal systems, directly translate into specific client needs. And therefore, revenue opportunities for a firm like Marsh McLennan, the discussion they had around discretionary project work versus the more recurring revenue stream, that's crucial.
Right, the consulting slowdown you mentioned.
Exactly. Management indicated about 15–20% of their total revenue base is more exposed to these, let's call them softer moments in the economy. Yet their ability to manage expenses, their track record there, and how they execute scenario planning gives them confidence they can still maintain margin expansion. That's key.
And the insurance pricing, that divergence seems important too.
Absolutely. That divergence, property rates falling while U.S. casualty rates surge. It underscores a really complex underwriting environment for the whole P&C insurance sector, not just for Marsh McLennan's clients. It signals a shift in where risk and profit pools are forming. It's creating a very distinct, almost split landscape.
And lastly, that consistent investment in AI, leveraging their proprietary data. It positions them not just as a services firm, but potentially as a sophisticated data and analytics powerhouse.
A tech-enabled services firm, almost.
Sort of, yeah. And that could be a huge long-term differentiator in what's a very competitive market. It could really set them apart.
So looking ahead for 2025, they're sticking to their outlook.
Yeah.
Expecting mid-single-digit underlying revenue growth, solid growth in adjusted EPS, and their 18th consecutive year of reported margin expansion. Though, of course, they added the usual caveat that the economic backdrop could, materially differ from their assumptions.
Right. Always the caveat. Okay. That brings us to disclaimer time. The following is purely for informational and entertainment purposes only. It should definitely not be considered financial advice. Please, you do your own research. Okay.
You got it. Always do your homework.
Ah.
Now, that being said, if I were pitching to an investment committee, just spitballing based on the trends we just discussed, here's a provocative idea. Let's call it the nuclear verdict hedge.
The nuclear verdict hedge. Okay, that's definitely a provocative name. Unpack that for us. What's the idea?
Well, given this continuing surge in U.S. liability insurance costs and that absolutely unprecedented increase in nuclear verdicts, those massive payouts over $100 million we talked about, the idea is to consider a tactical short position. That means betting against something, expecting its value to fall.
Okay, shorting what exactly?
Maybe a diversified property and casualty or P&C insurance ETF. or perhaps a basket of specific U.S.-centric P&C insurers, particularly focusing on those with significant exposure to long-tail liability lines, things like general liability, professional liability, where claims can take years to develop and settle.
And the thesis behind that short bet?
The thesis is basically this. While many P&C insurers are trying to react, maybe diversifying or pulling back from certain lines, the underlying systemic issues, the U.S. tort system problems, the escalating litigation costs that Marsh McLennan highlighted so clearly, those suggest that even with significant rate increases in areas like excess casualty, the pressure from adverse reserve development and just the sheer frequency and severity trends will likely continue to squeeze underwriting profitability, maybe more severely than the market currently anticipates.
So you're betting the rate hikes won't be enough, essentially, yeah. The trade capitalizes on that deep structural tax on the economy that even large, well-managed insurers might struggle to fully absorb or pass on. The bet is this could lead to sustained margin compression for those insurers and maybe some unexpected earnings misses down the line. It's basically a bet that this rising cost of risk environment, specifically in the U.S. liability space, is actually a profit sink for many insurers, despite their best efforts to offset it elsewhere.
Definitely a bold idea, directly leveraging those structural challenges Marsh McLennan talked about.
Bold, perhaps, but grounded in the trends discussed on their call.
So there you have it, a comprehensive deep dive into Marsh McLennan's second quarter. They delivered, solid financial results, while also being really open about the profound uncertainties shaping the global economy and those specific thorny challenges like the U.S. litigation environment. Yeah, they clearly articulated their strategy, leveraging their unique capabilities, especially in data and AI, to guide clients through these really complex times. Hopefully this deep dive equips you to understand not just the numbers, but maybe some of those critical underlying trends that are impacting industries worldwide right now.
We definitely encourage you to consider how these insights might apply to your own understanding of the markets and the challenges businesses are facing today. For instance, thinking about that tax on the economy from rising litigation, what other industries might be feeling that pinch, maybe in ways we haven't discussed? Something to think about. Thanks for joining us on the Deep Dive. We'll catch you next time for another Deep Dive.